Now you know what the S&P 500 is, and we teed up 3 components to becoming a millionaire: a monthly regular investment, a fund that tracks the S&P 500, and a magical third component that we'll talk about in episode 15. But for now, let's just answer last week's deep dive question. So I said, in 2013, I purchased a $5,000 US Treasury bond with a 7.5% coupon rate and a maturity date of November 15th, 2024. In 2013, that bond cost me $5,269.73 to purchase. Was that a good investment or not? The quick answer is no, it was not. I mean, in terms of actually putting money away and earning interest, of course, any kind of savings that earns interest is a good investment. But how does it compare to others? Well, let's break it down. In 2013, I paid $5,269.73 for a $5,000 US Treasury bond with a 7.5% coupon rate that matured in 2024. Now, we learned in our bond deep dive why that $5,000 bond cost me $5,269 and change. The reason was that Treasury rates in 2013 were only paying in the mid 3 percentage points. The bond I bought was issued in 1994 and at that time paid 7.5%. So in order for me to get that 7.5% rate, I had to pay a premium. Thus, the $5,000 bond cost me an extra $269. So from there, we have some easy math. 5,000 times 7.5% interest equals $375. So what that means is I was paid $375 in interest every year until the bond matures. Now, in my case, I bought the bond in 2013. And it matures in 2024, so that's 11 more years of interest to earn. So 11 times 375 equals $4,125. So the bond matures, I get my $5,000 back, plus $4,125 interest. Remember, I only get back the value of the bond, which is $5,000, not the $269 premium I paid to get it in the first place. So I invested $5,269.73 in 2013, and voila, in 2024, that will be worth $9,125. That's great, right? Not really. From mid-2013 to mid-2024, the S&P 500 average rate of return was 13.05%. So if I put $5,269 into the S&P 500 in 2013, instead of buying that bond, $5,269.73 would be worth $20,309.74 today. That's a big difference. By the way, you might be asking, why the heck did you buy that bond in the first place? The simple reason was I didn't understand how bonds worked back then. I just saw a high interest rate on a bond and I bought it. Now, there's a few other things to consider. First of all, the stock market could have just as easily gone south, a huge crash or something, whereas a US Treasury bond is perfectly safe, virtually risk-free investment. Have you had any investments you didn't fully understand but they worked out or didn't work out? Let me know in the comments below and we'll chat about them next week. See you next Sunday.